variance. That is a question that is pending on this particular workbook, and that is a question that we are starting with before we continue to the other workbook. And I will read through this particular question. I will read it through, and the question reads: Cliptomine Limited manufactures a single product, that is K20, whose standard cost is 7,500, made up as follows. So we have direct material, which will require 20 square meters at 200 per meter, which gives us a total of 4,000 per unit. Direct labor, 5 hours at 400 per hour, 2,000. Variable overhead, 5 hours at 200 per hour, 1,000. Fixed overhead, 5 hours at 100 per hour, per direct labor hour, which is 500. So you get a total of 7,500. Additional information: the standard unit selling price of product K20 is 9,800. Number 2, monthly budget production and sales is set at 1,000 units. So this is budgeted. The following figures relates to the month of October 2020. Sales, we sold 150 units at 10,400. Then production 1,200. There was no opening stock. Direct material 18,800 square meters at 400 per square meter. Then direct wages 5,800 hours at 500 per hour. Total variable overhead 942,000. Total fixed overhead 600,000. So we are required actual profit or loss statement, and we prepare the flexible profit or loss statement, and Roman 3, a reconciliation statement for the reported variance. For the reported variances, we try to do the reconciliation statement. So the actual will be based on note number 3, and we need to prepare the flexible profit statement, and we shall base that. You either calculate it on the budgeted, or you can go the short way, whereby already we know the actual, and we shall see that how to go about that question. So we had this other part that is not relevant. This one was not relevant. So I'll start by calculating the actual profit statement. Let me just do it here. My actual profit statement. So the actual profit statement, profit or loss statement, and the actual, we are starting with sales here. So we shall have our sales, and our sales, we are having, we sold 150 units at 10,400. 150 units at 10,400, and less production cost. The cost that we incurred in producing, cost that we incurred in to support is like the cost of sales. Less cost of sales, or the production costs, because they are dealing with the manufacturing. So the production cost is cut with the direct material. And our direct material, we are told we use 18,800 square meters at 400. I'll use it here. 18,800 at 400 per square meter. At 400 per square meter. That way. Then we had direct wages. And our direct wages, in our case, was 5,800 hours. 5,800 at 500 per hour. 500 per hour. And the next one was total variable overhead. So the variable overheads, so it was the total, which was 942,000, and the total fixed cost. I'm just combining all of them. total fixed costs. You can decide to go the route of finding the contribution, but in this case, the way they had given us at the beginning, all of them to get the unit cost. So we are using all of them, the 600,000. So that is the production cost that we incurred. And remember now, this cost that we incurred, it was to support production of 1,200 units. 1,200 units. So 1,200 units, they are the units that we produced. But instead of selling 1,200, we ended up selling what? 150 units. We only sold 150 units. Remember, they are telling us we did not have any opening inventory, no opening inventory. But because we produced 1, 2, and we sold 150, it means there will be closing inventory. There will be closing inventory. There will be closing inventory. First, I'm getting the total of these. So this is the total production cost. The total production cost that we incurred. So in this case, according to the standard that we have been given, they were using what we call the absorption costing. Yeah, not the marginal, because under these, the standard, they had already included the fixed overhead as a variable, so that to get the unit cost of 7.5, yeah, the unit cost of 7.5 that they had gotten there, so that here the closing, our closing inventory, our closing inventory. So closing inventory that we have, we shall calculate. Remember the production. So we produced what? 1, 2, and we sold 150. We sold 150. So we shall have the balance, which is the closing of 1050. Yeah, our closing will be the 1050 as our closing inventory, and therefore here 1050 will be closing, and this closing inventory, it's normally valued. Yeah, it will be valued at the unit cost, and our unit cost was we have a unit cost here. Yeah, this one, 11. Let me think about that. So it will be our unit cost. The unit cost will be the total production cost, which is 962,000. Yeah, 962,000. We divide by the actual production, what we produce, the units, which was 1,200. It means one particular unit was costing 99.68, 99.68.33. Yeah, one unit that we produced was valued at this. What about this value? So 99 by 1050, the one that remained. It means out of the 11 that we produced, 10,466,750 was a part of the closing inventory. This was part of the closing inventory. I can put a negative sign, the closing, so that here we get these two. So the cost that we incurred to support sales of 1560, the cost was 1495. The cost was 1495, and it will give us a profit, our profit of the difference between the two, and we minus this. So that means our profit will be the actual profit. It's supposed to be that value, the 64,750 as our closing event, our profit for that case, our profit for that matter. And that is how the first part was supposed to be done. The first part was supposed to be done that way. Then the second part of it, the flexible. And when you look at the flexible, the previous question that we had done for the flexible budget, I think we prepared it from the budgeted. Yeah, from the budgeted. And remember, when you're preparing the flexible budget, there's something you are calling the flexing factor. I'll just illustrate that. Flexing factor. flexing factor, and the flexing factor we said is actual units, and you divide by budgeted units. So actual units over budgeted units, the actual units that were sold divided by the budgeted unit, so that you can be able now to flex the original budget. The original, remember, is a budgeted, the original budget that was planned. We now flex it to reflect the actual, to reflect the actual sales that were sold. The actual sales were sold. So in this case, if you were to use that one, you will find that our actual units that were sold was 150 vis-a-vis what was budgeted in note number 2. Note number 2, the budgeted was 1,000, and it will give you 0.15 as our flexing factor. 0.15 as our flexing factor. So where shall we use this 0.15? So if you are to use this format of going through the flexing factor, you will first need to prepare the original.
Mwalimu, can you kindly repeat the flexing factor?
Yeah, so the flexing factor, we are saying we are taking the actual units and we divide by the budgeted. Actual units divided by the budgeted units. Divided by the budgeted units. And we are saying in this case, our actual units that were sold was 150. The 150 that was sold in note number 4. And the budgeted, we had budgeted in note number 2 to sell 1,000 units. So we had budgeted to sell 1,000 units. To sell 1,000 units. And that's why we'll get a flexing factor of 0.15. Flexing factor of 0.15. And we are saying for you to apply this one now, for you to apply this one, you will need now to prepare the original. Let me show you this one. Assuming like the budgeted sales, if we are to have the original, let me just prepare here. Yes.
Just
go ahead, Otieno.
Is it that this flexing factor? Is it normally based on the number of units produced only, or it can be based on other factors? Maybe let's say the sales, expected sales over actual sales.
Okay, so we base it on the
How
sales.
do you know that you are supposed to? Which question are you using, the units produced or maybe the other factor? Maybe.
Okay. Yeah.
Mwalimu, you know what has confused us most? I think in the equation we have the actual sales units and the actual production unit. And for us all along, we've been knowing that we use the actual produced units divided by the budgeted units. But now you're using the sales units over divided by the budgeted units.
Yes. So remember what we normally use, whatever we are dealing with, when you talk about the flexing factor, we are not using the production, we are using the sales. Yeah, the sales, because we normally flex it based on the sales units, and not the production units. And this is the reasoning that assuming, let me just calculate the budgeted sales. What we had budgeted, our budgeted sales, and our budgeted sales, we had budgeted to sell 1,000 units, and we had budgeted to sell it at 98. This one, the standard unit selling price was 98, meaning that you should have gotten these 9.8 as what was budgeted. But now remember, these 98 is 1,000 units that we are selling. Is the one that is giving us 98. But what if now we sell 150? That is where now the question comes in. What if we sell 150 because we ended up selling 150 vis-a-vis what we had budgeted of 1,000? So in this case now we'll find that our sales will reduce. That's why we are saying the flexible. The flexible now will capture the actual sales, not the actual production that we had. Yeah, the actual sale that we sold, so that now we can be able to capture that. And if you can remember the previous question that we did using the sales units. Although that question did not have
Well,
the difference.
the previous question, no, it was
Mm-hmm.
straight because those units that we produced, we sold all of them.
Yeah, we
So
sold
you
all
are
of
not
them.
be able. Yes.
Yeah, yeah. So that's why now I'm clarifying. In this case, now we are dealing with what we sold. Yeah, what we sold, not what we produced. So we are flexing it based on the units that we sold, but not the units that we produced. The units that we produced. So that's where the difference is coming from. Yeah, so that if we base on these now, yeah, we base on these. Remember now, if we had sold 1,000, we are supposed to make what? We are supposed to make 98. But what if we sell 150? What will be now our projected? Because this actual statement that we are reporting is based on sales. And that's why even the cost, we have deducted what? We have eliminated the part that we closed, the closing inventory, so that the actual profit will be based on 150 units that we sold. And this cost of 1495 again is based on the actual units that we sold of 150. That's why we have eliminated the 1050 because that was part of the closing inventory. Yeah, the part of the closing inventory. Yes, we produced more, but we did not sell everything. And that's why even the flexing factor or the flexible budget is supposed still to reflect this. Yeah, that if we had budgeted for 150, what will be the statement look like? Yeah, our statement of profit or loss will look like what? Yeah, that's the reasoning. So that
Maybe Mwalimu has a question
yeah, continue.
on the actual profit and loss statement.
Yes.
If actually we could be having an opening inventory of
Uh-huh.
certain units.
Uh-huh.
Now, my question is,
Uh-huh.
we will add, we will start with it, then we add the direct material and direct labor and overhead fixed roll, and then less the closing stock.
Yeah, we
But
let the
now my
close.
question is,
Mm-hmm.
uh, if they give just units
Mm-hmm.
without giving the exact figure, do we speculate
Mm-hmm.
that probably we
Mm-hmm.
use the same production cost per unit of 9,968 times the number of opening stock units? How much does
Yeah.
it?
Yeah, of course, yeah, it will mean the same thing, because these 99, most likely what will happen is that if they give you the opening, they're supposed to give you the valuation of the opening. So very hard, they cannot give you the opening without the valuation because this cost that we use is the one that will be based to calculate the closing, but not the opening. So if they don't give you the opening with the valuation, that one would be hard to find the cost of that because the cost and the assumption, unless you assume the cost will remain constant, yeah, the cost will remain constant, then you can multiply by the same valuation of 9968.33, assuming that especially for these ones. And remember now we are using what we are calling what the absorption. Absorption assumes even the fixed cost is variable. Like the same thing here we can be able to get the fixed cost per unit. So the same assumption can apply that unit cost will remain constant regardless of the number of units. So you can be able to take the unit cost, multiply by the number of units that we had in the opening inventory and still get the valuation of it. So still that one can apply. Okay. So the monthly production of 1,000 units and production units of 1,200. So the 1,000 was what was budgeted in note number 2. So this was monthly budgeted production and sales. So we had budgeted we shall produce 1,000 and we shall sell 1,000. So there was no anything that we are remaining or we are being left with under the closing under the budgeted. So we had planned we shall sell everything and produce the same units that were produced were the same units that were supposed to be sold under the budgeted, but the 1-2 was under the actual, yeah, the actual results. Under the actual results, the production was 1-2, yeah, 1-2, and they were categorical. They did not have the opening, so that we produced 1-2, but we ended up selling 150. We ended up selling 150. That's the difference between the 1-2 and the 1,000. Okay, so having said that, so we need now to prepare these flexible, the flexible budget. And I was explaining that for you to get these, there are two ways to get the flexible. Yeah, you either first calculate the budgeted, then you use the flexing factor, like this one that you have gotten 98. If we are to flex these, we shall take 98 and we multiply by this. the flexing factor, so that it will give us 1470. It will give us 1470,000 as our budgeted sales under the flexing factor. Or the other way that now we can be able to deal with these, the shorter way, is the one that we shall use instead of using all this, because now using this requires us first to prepare the budgeted. It will require us to prepare the budgeted sales or the budgeted income statement. Then now we flex the entire thing apart from the fixed cost. So we can take what we are calling the budgeted in actual or actual in standard. Actual in standard. Here we are producing 150 units, but under the standard they are selling it at 98. Under the standard they are selling it at 98, and you'll find that it will give you the same answer. Yeah, we'll end up with the same answer of 1470. So we are taking the actual units, now we multiply by the standard prices. Yeah, actual units sold by the standard prices, and that's why we are getting the flexible. So flexible is just actual flexing it using the budgeted units, actual in a standard proportion. That one will give you the budgeted. So instead of first preparing all this budget, then we flex it, you can just go directly by preparing the actual in standard proportion, and that one still will amount to the budgeted or the flexible budget that we are having. So I'll just copy this item that we had here, because they are the same item that will be replicated with an exemption of the closing. With an exemption of closing, because under the flexible or under, because we are preparing it from the budgeted, we did not have any closing inventory. So that our sales, we are saying we are taking 150, the actual units sold by the budgeted selling price. Yeah, where we had budgeted to sell it at 98. So the flexible part of it, the sales will amount to 47. To 47. It will amount to 47. 47 or 1470, not 47, 1470. Then we less the production cost. So direct material we had budgeted, or the actual direct material used was 18,800, and we had budgeted 1 meter here. 1 meter of the direct material was 200. Yeah, what was budgeted was 200, so we shall multiply that by 200, the amount of direct material that was budgeted, which was 3760, the one that was budgeted, and we shall prove that. Yeah, I will prove that when we calculate the budgeted and see whether it will still yield the same value. Then for the wages, we were having 5,800 hours. Yeah, 5,800 hours, and yeah, I believe that one will not add up. Just a minute. I just see this one for the for the labor, so that I don't mislead. So the labor we had, not labor but material. Yeah, material, you are having 4,000 per unit. So 4,000 by 1,000. Yeah, 4,000 by 1,000, because 4,000 is per unit, and we had budgeted to produce 1,000. So we are supposed to have these. Yeah, that value, the 40 or 4 million. So if we were to flex these, because it is flexible, we multiply by 0.15. So
it doesn't add up.
Yeah, it doesn't add up. Yeah, it doesn't add up. It's supposed to be 600. Meaning that if it was 600, we had planned to sell 150, not 150. So the production, we had planned to produce 1, 2. I'll go with this one. 1, 2, and each unit will require 20. Each unit will require 20 square meter at 200. Each unit will require 20 square meter at 200, and still that one will not add up. That means I will go back to the root of the budgeted. because that one is misleading. It's not giving the correct value. Just a minute. 150 by 20 and by 200. Yeah, I think that should be the correct order. So here everything, because we are dealing with 150, the actual units, we are dealing with 150. That means all of them, even the production, because we are flexing it based on the actual, we shall use the 150, the one that was actually sold. That is what we shall use, because it's still the same as using the 0.15, 4000 by 0.15, which is giving us the 600. So you are not using the total of 12 but 150. Yeah, sorry for that. The same with wages.
I think this
Yes.
shortcut will confuse us more. We could have just gone with the longer way, and
okay,
so it will be better. This one we will get more confused. That's what that's my side. I don't know.
So let me prepare.
Very true, Mr. Otieno.
So I'll prepare both. Let me prepare both of them. So we shall have the budgeted or the original. Yeah, the original budget. Original budget, and then we have the flexible. Flexible budget, so that to avoid confusion this last minute, and I will have just copy this what we have here, our cells, yeah, that way. So I first prepare this original that we have, and we have said here is 1000 that we are producing, and a unit is 4000. So for cells, 1000 by 98, 1000 by 98, the 98 that we are selling at, which was giving us 9.8. Then for the production, that is a direct material, 1000. That is what was budgeted, and one unit was 4000, which was supposed to give us the 4 million. Then the wages 1000, and each one at 2000, and the variable 1000, and each one at 1000. Million, and the fixed 1000, and each unit at 500. So that you get that this is our production, our production cost, the original one. So the total of them, which will give us 7.5, and our budgeted profit, which will be the difference between the two minus this one, which will give us 2.3. So that was the profit that was actually budgeted, under that. So for the flexible, we have said for the flexible, we are having that flexing factor, which was 150, and we divide by 1000, which was giving us 0.15. So we shall flex now this original, and because already we have prepared it, it becomes just easy to prepare the part that is flexible. You take the cells and you multiply by the flexing factor, and we come to this one. Our multiply by this, and I will lock this. The flexing I will lock because it will affect the first three. It will affect the labor, material, labor, and variable overhead. The three of them will be affected. By our flexing factor. But you'll find that for the total fixed overhead, that one does not change. Yeah, the fixed will remain fixed. Yeah, it will remain fixed. That one will not change. It will not be flexed. And you get the total for that. And you get your profit. That way. So in this case, we made a loss under the flexing factor. Under the flexible, we are making a loss. loss of 80, loss of 80, 611 plus 450 after 1550. So we had a loss, and the reason of the loss is because of the fixed. The fixed has remained fixed. It has not changed when the level of activity has changed. So that is the second part, how it was supposed to be prepared. Either the easier one is this one, which one does this one does not have confusion on whether you are sure of the figure that you're getting or not. This one is direct, because whatever you get as your original, then that is what you will get as the flexible. You flex that, and the only part that we are flexing the variable, variable overhead, variable overhead. So we do that part of the reconciliation now, reconciliation statement for the reported variances, reconciliation statement, and you'll find that when we are reconciling, we are reconciling the budgeted, the original one. Yeah, normally the variance is for the original, and this one, the actual. Original and the actual, original and the actual is the one that we are using to calculate the variance, original and the actual, not the flexible, because the flexible we have gotten it from the original. So the variances that will be there is from what we had budgeted initially and what we got as our actual results, Remember, we said for the flexible is normally prepared at the end after we have obtained the actual results. That is when we shall prepare the flexible budget. But the original was prepared in advance, and it is the one that we use to control so that we can know by the end of the day whether we achieved what we had budgeted or we exceeded the budgeted amount, and by what particular amount. So shall calculate our variances. Yeah, remember variances, we said we have variance for sales, variance for material, variance for labor, and variance for overhead. The overhead, we have the variable, and we have the fixed, the overhead variable and the fixed. Yeah, the two of them. The four, so they're supposed now to be four: the one for sales, the one for material, the labor, and the overheads. Overhead, we just term them as one variance, but you just need to know that we have the variable and we have the fixed. And we start with what was budgeted, the budgeted profit. Yeah, budgeted profit. And our budgeted profit, in our case, we had 2.3. 2.3 was what was budgeted, and we start with the variances for sales. Yeah, for sales price or sales margin, price variance. Let me just write it here. So the sales price, or you can talk about the sales margin, whichever term you use, it will mean one the same thing. So sales margin, price variance. So this is a variance for the price, especially for the sales. What we had budgeted to sell at and what we had as our actual. So remember, this one we said we take either way the budgeted price, you minus the actual price, and you multiply by the actual quantity. So budgeted price, what we had budgeted to sell 1 unit, and we minus the actual selling price that we sold and the number of units that we sold. That one will give us that variance. So we had budgeted to sell at 9,800, but our actual selling price was 10.4. Note number 3, we sold 150 at 10,400, and our actual units that we sold, they were 150. Actual units that were sold were 150. So 98 minus 10.4 and by 150, and you'll find that this one may be misleading, but you said the key thing is to understand when you're dealing with the sales price. The higher, if the actual price is higher, it's supposed to give you the favorable, but if the price is lower, it's supposed to give you the adverse. In this case, actual was more than the budgeted, but when you enter, you'll find that it is giving us a negative, of which is not supposed to be a negative. It's supposed to be a positive value, and therefore you have to readjust that value, or if you don't want to adjust, you can change this. We start with the actual minus the budgeted, but remember, for the cost, the formula is directly budgeted minus actual. Yeah, the key thing is that you need to know the interpretation, so that to know when it is favorable and when it is adverse. In this case, it is favorable because the actual selling price was more than what was budgeted. We budgeted at 9.8, we ended up selling at 10.4, so it's a favorable variance of 90,000. Favorable variance of 90,000. Then the second one that we are having is the sales margin volume. Yeah, sales margin volume variance, and you'll find that for the sales margin volume variance, we said here we take the budgeted quantity because it's the volume minus actual quantity, and you multiply by, so budgeted quantity minus actual quantity, you multiply by the budgeted profit, because we are using the we are using the absorption. Yeah, budgeted profit. If you are using the marginal, we use a budgeted contribution. Yeah, budgeted contribution. And how will you know the basis that they are using? Are they using the marginal or are they using the absorption? You will know by the way the standard is being given. Yeah, under the basis of marginal, standard comprises of three elements of cost. Only the direct material, direct labor, and variable production overhead, the three of them. But the moment they include the fixed, treating it as though it is variable, that one is the absorption costing that deals with that. And that's why their standard cost per unit was 7,500. 7,500, meaning that the profit per unit, profit per one unit, is supposed to be the 9.8, what we had budgeted, minus 7.5, the unit cost. For one unit, they are making 2,300. Yeah, that is the 9.8, what we had budgeted to sell at, minus the budgeted cost per unit of 7.5. So you're getting 2.3 as your profit per unit. Therefore, in this case, we had budgeted to sell 1,000 units. We ended up selling 150. And the profit per unit is 2,300. This one that you have gotten it here, 2,300. So you'll get that in this case, again, it will be the opposite, because it's supposed to be we sold less, especially for sales. And for sales, if you can be able to interchange the two, the better. You'll not need to deal with either checking the signs, because whatever we sold was less than what we had budgeted. So it's not favorable, supposed to be an adverse variance. We sold 150 instead of selling the 1,000 units that we had initially budgeted to sell or intended to sell, and therefore it will give us an adverse variance of 1955. So for sales there are two. We don't deal with the other, the mixes. We normally have the sales, the mix and the yield. So just deal with the margin, the price, and the volume. Then material, deal with the material price variance. And for material price variance, we said is actual standard quantity. So standard quantity SQ minus AQ. Standard quantity minus actual quantity into standard price. So here we are using S. So SQ is the standard quantity of material that we had budgeted to use. And so this is the price, sorry, we had gone to usage. So standard price, actual price into actual quantity. So material price, yeah, it was a price. So standard price, we had intended to buy 1 meter at what particular price, and we ended up buying at which particular price, and the actual quantity. And you'll find that here we had budgeted to buy a meter here. These are the standard costs. Direct material 20 square meter at 200. So we had budgeted to buy at 200 per meter. We ended up buying in number 3 the direct material 18,800 square meter at 400 per square meter. So we bought it at 400, and the number of meters that we actually bought was 18,800. The actual meter that were used 18,800 square meter, the actual quantity. And you'll find that it will give us an adverse variance of that is 760,000. That's 760,000. That is for the price. Then for material, again we calculate the usage. Material usage variance. So for the usage is one that I had written the standard quantity, actual quantity, and standard price. Yeah, standard quantity minus actual quantity into the standard price, And in this case, we say the standard, we deal with the standard in actual. Yeah, standard in actual, what we had budgeted under the actual production, what we could have used vis-a-vis what we used, and we compare or we multiply that with the standard price. So I'll use two brackets, and the main reason for the two, the standard quantity, remember we had budgeted to produce 2. Here we use now the production. We had budgeted to produce 2 units, and 1 unit under the standard, it was supposed to consume 20 square meter. 1 unit was supposed to consume 20 square meter. I will close that bracket, 20 square meter, but the actual that we used was 18,800 square meter. We had budgeted to produce, the actual production was 2. If we went through what we had budgeted at 20, we could have used 1,200 by 20, which is 24, I think 24,000, but we ended up using 18,800. So we used less by the standard price, and our price was 200 per meter, by the standard price of 200. And that's why you'll find that it is giving us a favorable variance of 1040, because the actual quantity that we used was less compared to the quantity that we had planned to use. It was less compared to the quantity that we had planned to use. So that is the two again under the material. Material is the price and the usage. Price and the usage. We go to labor. Again, we calculate 2 under the labor. So labor rate variance. And when you talk about the rate, they are the prices. Labor rate variance. So we say this one is equals to standard rate, and we minus actual rate. Actual rate into actual hours. Standard rate minus actual rate, and you multiply by the actual hours that were used. And you'll find that the standard rate, we had budgeted to pay direct labor hour 400 per hour. That is what we had budgeted, 400 per hour. But the actual that we used, here was 500 per hour. So we paid more. We paid more than what we had budgeted, and we multiplied by the actual hours. And the actual direct wages, actual hours were 5,800. Actual hours of 5,800. So you get an adverse variance of 580. And the other one is the labor efficiency. How efficient we were. Labor efficiency. So labor efficiency variance. For the efficiency, we are starting with the standard hours and the minus actual hours into standard rate. Standard hours minus actual hours into the standard rate. And again, here when you talk about the standard, it's standard in actual. So we had budgeted to produce 2 still 1, 2 comes into play. And 1 unit, we had budgeted it will consume 5 hours. A unit was supposed to consume 5 hours. 5 hours, that way. I close that. But the actual hours that we used were 5,800. This one, 5,800. And the standard rate of 400 per hour. Standard rate of 400 per hour. You'll find that we shall get a favorable variance of 80,000. Favorable variance of 80,000. That way. And those again, they are the two of them under the labor. The two of them under the labor. And we go to the next of variable overhead. Yeah, so for the variable again there are two. Yeah, variable overhead expenditure, variable overhead expenditure variance, variable overhead expenditure. And for the expenditure, we said is actual hours by standard rate. You can open this actual hours and you multiply by standard rate, and you minus the actual variable overhead. Actual hours, you multiply by the standard rate and you minus the actual variable overhead. You minus actual variable overhead and our actual hours. So one thing you should note when you are dealing with variable overhead, the variable production, they do vary with the direct wages. And therefore the hours that are used or the hours that are employed in the direct wages, they are normally the same hours that are employed under the total variable overhead. And a good example is like here, where the direct labor hour 5 hours and even for the overhead is 5 hours. Both of them are having the same number of hours. Therefore, because the absorption, the basis is the same, so the same hours will be applied there, the 5/8. So when you talk about the actual hours, we'll talk about that 5/8 at the standard rate. And our standard rate per hour was 200 per hour, what we had budgeted. And our actual variable overhead, this one that we had here, 942. Then we had it here, 942. You can just minus from that point. You'll get a favorable variance again of 218, which was favorable, meaning the actual was less. The actual was less than what we had budgeted. The actual in standard was more than the actual variable overhead. Variable overhead, we say there are two: the expenditure and the efficiency. Again, expenditure and the efficiency. So variable overhead efficiency. Yeah, efficiency variance. And this one is standard hours. So standard hours minus actual hours into standard rate. It's almost the same thing with the labor efficiency. Almost the same thing with the labor efficiency. The only difference is on the standard rate. Because the rates are different. But the other calculation, the same way we are calculating, where the standard is standard in actual 1, 2 units, and we require 5 hours. And our actual was 5,800, the actual hours. So for the labor, the standard rate of labor, not labor but variable, was 200. Remember, labor was 400, variable overhead is 200. So that's what we shall use here. The variable overhead, standard rate of variable overhead of 200, and we'll end up getting again a favorable of 40, favorable variance of 40. So labor variable overhead, we are done. The expenditure and
Walim,
yes, the efficiency.
I have a question.
Ask your question.
Instead of doing the two of them, how about I do this? The total, the actual total overhead is 942,000.
Yes.
Now it we go back to the budgeted. the variable overheads per unit, it is 1,000.
Yes.
When you times by the 1,200, you will get the actual production will get 1,200.
Yes.
So it means that we are the variable overheads we had budgeted to be 1.2, but we ended up spending 942.
Yeah,
So we subtract the
942.
1.2 minus 942.
Okay.
Then it will
And
give you
still we will
258.
get, yeah, 258. That one is still okay. That one is still okay. Whereby now we are using the totals. Yeah, instead
The
of
total.
instead of breaking these, even this one, instead of breaking them into the efficiency.
Even the previous ones, that's what I was thinking also. You have gone a long way. Instead of breaking it, for example, now the direct wages is giving us, for example, if we want to look at labor efficiency, we take the direct wages, which is
Yes.
the actual, which is 5,000 hours at 50, 500. It will give us 2.9.
Yes.
Now, when we go to the budgeted,
Yes.
the labor is 2,000.
Yes.
If you times it by the number of units, actual units we produce is 1,200, it will
Yes.
give us 2.4.
Yeah.
It means that we had budgeted to use 2.4, but the actual usage, it was 2.9.
Yeah, 2.9.
So we need to subtract it. It is an adverse to us. So it will be
Yeah,
negative
another verse.
500.
Yeah, negative 500.
The
Which
same
is
thing you
the
also do
same.
for direct labor.
Yeah, for direct
How,
labor.
how do you think of that?
That one is okay. Yeah, that one is okay. Very much okay, because that one now simplifies. It simplifies you the workload of mastering all these to break them two. That one now
Yes.
is easier. Yeah, it will be easier for that one. There's no problem with that. Yeah, as long as you can remember that we are taking the actual, so the budgeted is in actual. Yeah, budgeted in actual production, and now you minus the actual budget, the actual cost, and you get still the same thing. Yeah, so the only thing, this is longer because we are breaking them. So for that one, for material we shall have one, for labor we shall have one because it's the total, and for the variable still we shall have one, and for the overhead, yeah, I think even for the overhead you're supposed, just the fixed overhead, just supposed to have again one instead of breaking. Still it's okay. Yeah, because one thing we said in BDA, the shorter method, as long as you can master it, the better, because it will save you a lot of time. Yeah, a lot of time and a lot of headache, especially for this one, remembering all the formulas. Yeah, that one I approve, it is okay. Yeah, very much okay, because it is a shorter method of getting those variances. So thank you. Yeah. So that one we could have used it and we could have already finished this particular question. But let us just finish on this one. Yeah, the fixed. Yeah, because already we started on this. Just complete on this. So the fixed overhead. The fixed overhead. So fixed overhead expenditure again. For this one, we deal with expenditure, fixed overhead, expenditure variance. Yeah, expenditure variance. And for the expenditure variance, we said is just directly the budgeted fixed overhead, and you minus actual fixed overhead, So budgeted fixed overhead minus actual fixed overhead, and this will be, so what we had budgeted, I think we had it somewhere here. This was what was original. The budgeted was 500, and the actual was 600. Yeah, the actual 600, which gives us a negative 100, negative 100. And the other one for the volume. Remember, for the fixed, again, there are two when you're dealing with absorption. Yeah, the fixed overhead, volume variance. Volume variance. Volume variance. This is budgeted quantity minus actual quantity. Actual quantity. So BQ minus AQ. And you multiply by the overhead absorption rate, OAR, the rate at which they were being absorbed, OAR. Some of them call it standard rate, but it's not the standard, is the overhead absorption rate. It's the one that we use here. And here now, the budgeted is for the production, because the fixed cost we look at whether we were able to absorb, were you able to absorb the units that we produced? Were they able to sustain the fixed cost? So we had budgeted to sell 1,000, to produce 1,000, sorry, to produce 1,000, but we ended up producing 1,2. Ended up producing 1,2 as our actual, and they are being absorbed. They are being absorbed at a rate of 500. The budgeted or the overhead absorption per unit, 500. So we don't take per hour, so per unit, which is 500, and we'll get these. But you'll find that this one is supposed to be a favorable, not an adverse, because the actual production was more. Actual production was more than what we had budgeted. Actual production was more than what we had budgeted. So it's supposed to be 100, 100, of which now you'll find that the effect is 0. Yeah, minus and these. And when you look at the one Variances is telling us, it's still giving us 0 because the budgeted production was 1,2. Actual production in budgeted 500. What we had budgeted per unit. What we had budgeted per unit. Okay, so I close these and we minus the actual. Remember the actual was 600. 600 and you'll get a 0. Yeah, you'll get a 0. So combining the two, instead of going the route for expenditure and the route for volume, when you just deal with total overhead, total fixed overhead variance, you'll get still a 0 for that, a 0 for that. And we try to get this total, you'll find that it is giving us a very different value, the actual profit. The actual profit. Actual profit. So actual profit of 27. But remember our actual was not 27. It means the question either is a question because we have done it correct the right way, believe so. So the actual was supposed to get this, the 64, which was the actual profit, 64,750. But this one is giving us 25, a negative 25, 27,000, 25, 27,000. So that means there is a problem. Either the setting, especially that closing, yeah, that one can be the one that has caused all these. Yeah, the closing. But I will counter check it. Yeah, let me just leave it at that. I will counter check it and let you know where the error is coming from, whether it's from the setting, the original question, the way it was, because this is a management accounting question. I will counter check and I'll let you know where the problem was and why it is not reconciling. Most probably by tomorrow. Yeah, the sales ought to be negative. Okay, so the sales, okay, so they are not negative because we are basing on sales. All the sales were positive, they were not negative. Yeah, they were positive. The only thing is that for what we had here was 1560. Okay, so the sales variance, remember for the first one, the budgeted, the price was more, actual price was more, and based on that, even if we sold lesser quantity, it will give us a positive variance. But this one will be a negative because the actual was less than what we had budgeted to sell at, and that's why it was giving us a negative 55. Negative 55. I stop at that. This question, we just